So should you buy Bannerman Energy? There's so much hype online about certain mining stocks. We have the CEOs come out, talk about that. Every CEO talks a great game about their assets. But what we do on this channel is dive into the actual financials of the company to see if it's a good investment, meaning potential life-changing returns. Again, that's what we cover on this channel. Potential for life-changing returns, right? If you want your 8% yield, you can buy the S&P 500, but on this channel, it's all about life-changing returns. Bannerman Energy Limited, so much hype around these assets. Is it justified? Well, currently, Bannerman Energy, if we look at the financials, right, the most important thing about a company is the money it's generating. This report came out on March 2024 for their half-year financial statement. So this is about as recent as we can get when looking at the health of this company. So for Bannerman Energy, net loss for half the year, they've lost $6 million. Right? That's just a fact. That is what it is. Now, again, current year earnings are in the past. What matters is the future, but that's a glimpse at where we are. They are losing millions of dollars a year, right? Now, 3.6 million of that came from impairment of equity accounted investments. So they've invested a lot of money in these mines and they're impairing those a little bit over time. But in the first half of the year, they've lost 3.5 million. Again, that is the present. That's the past. What does the future look like? How healthy is this company? For that, we look at the balance sheet. Total current assets, meaning the assets that they could sell within a year to raise capital, $36 million. That is very positive, especially when the total current liabilities, the assets they need to pay within a year, are 1.6 million. So they are so solvent. They're not going bankrupt anytime soon. They have plenty of capital. And when you look at their total assets, 107 million, this includes not just current assets, but all the assets, the long-term assets that they can't liquidate within 1 year or don't plan to. Total assets, 107 million. Total liabilities, 1.9 million. So they have over $100 million of net assets in this company. This is one of the healthiest balance sheets I have ever seen. They have plenty of money, plenty of assets, very low liability. So that is truly massive, right, for this asset. Now, again, they have net assets of $106 million, but their market cap is $280 million. Right? Well, if you liquidated the company, you would get net assets of $105 million back. But if a billionaire were to come and buy this market cap, they would have to pay $280 million for access to that $105 million of net assets, right? So you could look at that and say, oh, it's not deep, deep value. It would be incredible to find a company with a market cap below its net assets, which we have covered on this channel a little bit. We just scratched the surface. This one does not have that. But again, what is the future like? This is the past. This is the present. What is the future like for this asset? Because again, very healthy balance sheet, lots of options for the future. It's not really fair to look at the market cap of the company and the net assets, because not all the value of the company is reflected on the balance sheet, right? There's years and years and years of future production that can come from these mines that are not reflected on the balance sheet. And this is their statement of cash flows. How are they either earning cash or spending cash? Well, they started off at the beginning of the period with $42 million of cash. They ended with $35 million. So where is all this cash going? Primarily payments for exploration and evaluation. So they're investing in the mines, right? That is a good use of capital. That adds value to the company. So overall, very solid financial position. Can it 10x though? Can it hit a $2 billion market cap? Our flagship Etango project is one of the world's largest, most advanced uranium development assets, benefiting from its location in Namibia, a highly established uranium production powerhouse, strongly de-risked through extensive drilling, technical evaluation, and process demonstration plant, fully permitted with a clear pathway to development, readily positioned to capitalize on the unfolding uranium market recovery. So that right there is, in a nutshell, what they are about. They have one of the largest uranium deposits in the world. They're saying it's a safe jurisdiction. Namibia, highly established production powerhouse country, and it's been de-risked because they just keep putting more and more and more money into nurturing this powerhouse asset. So when it comes to Namibia, right, it's in Africa, so people might initially shy away from that, but they're saying it's a recognized tier one supplier to global utilities, 45 years of uranium production and export, an excellent infrastructure, port, rail, and power, clear mining code, strong rule of law, strong community and social support for uranium. That's designed to ease the concerns around investing in Namibia, right? Seems reasonable. So here's the math related to their biggest mine by far, Etango 8, right? 15 years initial mine life, 3.5 million pounds of uranium average output per year. So at $100 per pound, that's $350 million of revenue per year from this mine for 15 years. It's a lot of revenue, right? That's billions and billions and billions of dollars in revenue for this tiny market cap company of a $280 million market cap. Cash OPEX excluding royalties. They're saying that they can get it out of the ground from this mine at $35 per pound. So that is enormous profit, right? That is why the market cap is higher than its net assets because it's factoring in massive profitability in the future, right? So once this is up and running, we're talking billions and billions of dollars in revenue and hundreds, if not billions of dollars of profit. So when you look at a mine, you want to look at the net present value of the mines, right? The net present value is a calculation done to determine the value of the mine. It takes all the future cash flow into consideration, all the future expenses into consideration. How profitable is that mine? If you factor in all the future profits from that mine, what is it worth today? So for Etango 8 at a $95 per pound spot price, extremely reasonable. They're saying the net present value of the mine is $614 million. Again, the market cap of this company is $280 million. That is truly positive for this company, right? At $80 per pound, $390 million. This is the post-tax net present value. Again, very healthy financials. So if these net present value calculations are correct, then obviously the company is massively undervalued. A market cap of 280 million at an $80 per pound spot price, which is below anyone's future projections for this scarce resource, $390 million for that one mine. So that's currently the status of the company. If you want to buy $614 million worth of assets, assuming the spot price gets to $95 per pound, you can buy that today for a $280 million market cap. Very, very, very positive for this asset. Now they have plans to extend the life of this mine, right? They could expand the mine and plant throughput and give it a 16-year mine life. And they have an extended life model, which will give it a 27-year mine life. And they're not giving us the amount it would cost to get it to a 27-year mine life. But the point is they can keep investing in it. And they're saying they can get 95.2 million total pounds of uranium out of this mine over the long term. So this is their roadmap to production. This is really what matters. So they're in the construction phase. They're going to be in the construction phase until the beginning of 2027. So this is actually very positive for this asset because while the uranium supply crunch plays out, they're not selling their uranium cheap. It's all in the ground. So as the nuclear renaissance unfolds, as the price of uranium gets more and more expensive, they're saying that they could start producing 3.5 million pounds of uranium per year beginning in 2027. So this is a call option on the future price of uranium. It's already undervalued relative to its current mines. Very interesting asset. And then they say they can get it to 6.7 million pounds per year of uranium if they expand it starting in 2029. So this could become a true powerhouse asset. Again, let's say 5 million pounds of uranium per year. That's $500 million of revenue per year and massive profits. Again, they're a low cost producer, $35 per pound or something like that. So just a cash cow in the future. Now, this is where the rubber meets the road, right? Because this is all well and good. What if it cost them $5 billion to get this mine out of the ground? That would be totally unsustainable. Now, what they're basing into their net present value calculations is the profitability of these mines. So, raising capital to invest and build out these mines should not be impossible at all, right? Now, obviously, it's difficult in a high interest rate environment. They would be wise to probably wait for a low interest rate environment and lock in easy funding and capital for these assets. But this is where the rubber meets the road, right? The company commenced a process to evaluate and progress various funding sources, including conventional project debt, as well as potential offtake and joint venture opportunities with strategic counterparties who can add value to the Tango project. That would be the best case scenario if you get a massive company like Cameco or some huge giant uranium mining company to invest and build out these mines, right? Give them a stake in the company to build out these mines. That would be very positive. Bannerman appointed Azure Capital and Vermilion Partners, both global affiliates of French financial services institution Natixis, to advise on and assist with executing the optimal funding mix for Etango. This is very important. They can't spend too much to make these economically viable, but they have a very trustworthy team. They've been able to accrue major value to this company. They have the healthiest balance sheet I've ever seen, over $100 million of net assets. They have so much uranium in the ground, decades of mine life in theory. So the big important question is, will they get reasonable funding? They can't dilute their shareholders, it seems, because they don't have enough market cap. Again, $280 million of market cap that they could potentially dilute. It doesn't seem like they have any plans on diluting their shareholders. That's very positive. So even if they do get a conventional debt loan, right, at an interest rate of like 8% fixed or whatever it would be, I don't know what their interest rate is, but if let's say it was 8% fixed, the uranium price grows more than 8% every year. The profitability of the mine grows. The debt stays the same. It actually shrinks in value over time if they can get a fixed loan. So this company has all the options in the world available to them. So for that reason, it is a strong buy, especially since the net present value of the major mines that it has is higher than its current market cap. They have a clean balance sheet. They're not going anywhere. So if you believe in the uranium supply thesis, if you believe that uranium is the new oil, if you believe that there's a nuclear renaissance taking place, which there is, Sam Altman, Microsoft investing in small modular reactors, just one example, right? Uranium is the new oil. Shipping containers, space vehicles, all planning to run on nuclear in the future, right? It's the one green fuel everyone can agree on. So as this nuclear renaissance unfolds, Bannerman's going to get more and more valuable. Their mine is going to get more and more valuable. If you're okay with investing in Namibia, which they haven't given you any reason not to be okay with. So that is Bannerman deep value in this asset. Very interesting asset, especially as it declines in price, right? It hit $3. Now it's off 50%, almost 50% from that high. What if we get lucky enough to get a panic selling driven macro environment that causes these assets to fall deeper and deeper into value? That's why people should get excited by sell-offs in these assets, right? Imagine if this goes down another 50%. The market cap is going to be way less than even its liquidation value, and definitely the net present value of the assets on its balance sheet.